A bank approves a loan. Numbers appear on a screen. No truck delivers cash. No vault opens. No money is physically moved. And yet, new money now exists. This is not a theory. This is not a loophole. It is the normal process through which modern money is created every single day. This single process has consequences. It affects inflation. It affects housing prices. It affects why debt keeps growing over time. Most people never see this process, but they live with its effects every day. Most people imagine money as something physical, cash in wallets, coins in pockets, gold stored somewhere safe. But this is no longer how money mainly exists. In modern economies, money is mostly digital. It lives as numbers inside bank accounts. More than 90% of all money today exists only as numbers, not as cash, not as coins, not as gold, just entries on balance sheets. And these entries are called deposits. Deposits are often misunderstood. They are not stored money. They are not piles of cash waiting in a vault. They are promises. Promises made by banks to pay you when you ask. What makes this system work is trust. Depositors trust banks to honor their promises. Banks trust borrowers to repay their loans. And the system assumes that most people will not demand their money at the same time. Banks do not keep all deposits in cash. They don't need to. They only keep enough to meet normal withdrawals on an ordinary day. If everyone demanded cash at once, the system would stop working. Not because money was stolen, but because it was never meant to exist physically all at the same time. Inside a bank, everything is recorded on a balance sheet. Deposits appear as liabilities. Money the bank owes. Cash appears as an asset, something the bank owns. Many people believe banks lend out deposits, but this is not how modern banking works. Banks do not wait for deposits to lend. Lending comes first. Deposits come later. Imagine a bank approves a $10,000 loan. No other customer's money is moved. Nothing is taken from savings. The bank simply types a new number into an account. $10,000 appear. That money did not exist before. It was not transferred. It was created at the moment the loan was approved. On the balance sheet, two things appear: the loan as an asset, the deposit as a liability, created at the same time. This process has a name. It is called credit creation. In simple terms, banks don't move money when they lend. They create it. This is often misunderstood. Many people think savings enable loans. In reality, the opposite is true. Loans create deposits. Loans create savings. This reversal explains why money expands during economic booms and why it contracts during downturns. When money moves between banks, they settle using central bank reserves. Reserves are not public money. They exist only inside the banking system. Their role is stability, not spending. Banks are not limited by deposits. They are limited by regulation, by capital requirements, and by whether borrowers can repay their loans. When loans are repaid, the process reverses. The deposit shrinks. The loan disappears. Money is destroyed the same way it was created. Modern money is not printed into existence. It is typed into existence through loans and erased the same way. In the next video, we'll follow this process into your wallet and see how credit cards turn bank-created money into everyday spending.